Imagine paying a hedge fund-style management fee inside a regular ETF and watching nearly $200 million pour in anyway in just a few months. That is exactly what is happening with one of the hottest new active ETFs on the market. The brand name behind it is doing the heavy lifting. The fund is called the Baron First Principles ETF. It trades under the ticker RONB on the New York Stock Exchange. It launched in late 2025 from Baron Capital, run by Baron himself, the legendary growth investor known for huge long-term winning bets on Tesla, Spotify, and Nvidia. RONB is the closest thing to that trademark Baron strategy that retail investors have ever been able to buy in an ETF wrapper. So how does it actually work? RONB is an actively managed all-cap U.S. growth ETF. Baron's team picks roughly 28 high-conviction stocks across small, mid, and large cap. The top 10 holdings make up almost 58% of the fund, so this is not a quiet, diversified index. It is a concentrated bet. Sector mix tilts heavily toward consumer discretionary at 36%, financials at 24%, and industrials at 19%. But here is the catch they do not lead with on the website. RONB charges 1 full percent in management fees. That is roughly 6 times what a passive growth ETF like SCHG or VUG charges. On a $100,000 position, that is $1,000 a year, every year, in fees. Active management is not free, and Baron is positioning RONB as a premium product, not a cheap passive product. Why does this catch exist? Because Baron's team genuinely believes their stock-picking edge can beat the broad market by more than that fee over time. Baron's flagship mutual fund track record actually supports that claim across decades, but translating a great mutual fund track record into a brand new ETF is a separate question. New funds always start with no track record, no full year of audited performance, and a real risk that fee drag eats the alpha. Performance so far has been strong. RONB has pulled in nearly $200 million in the first few months since launch, and the fund has delivered solid returns out of the gate, riding the same large-cap growth tailwind that has powered the Nasdaq. But a few months is not a real cycle. The real test will come when growth stocks pull back hard and you find out whether Baron's stock picking holds up or whether you would have been better off in a cheap index. So who is this fund for? It is for an investor who wants real, concentrated active management from a name-brand growth shop, who is willing to pay a premium fee for it, and who can sit through the volatility that comes with a 28-stock, high-conviction portfolio. It is not for someone who wants a low-cost core holding. For that, you want SCHG or VUG. Honest caveat: 1% in fees compounds. Over 20 years on a long-term hold, that is real money lost to fees if Baron does not beat the market by more than that. You are paying for skill. Make sure the skill is actually there before you commit. If this was useful, hit like, subscribe for more new ETF breakdowns, and tell me in the comments, would you pay 1% for an active manager or stick with cheap index growth? See you in the next one.